Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Michelle Akufo. Here are three things you need to know to start off your Friday morning. Global stocks look to close out the strongest week in 2 months on a high. The S&P 500 coming off of its sixth day of gains, and that's its longest winning streak since November of 2021. That's what it takes us back to. The AI-fueled NASDAQ also going gangbusters, now on pace for an eighth positive week in a row. There could be a test ahead today, however, with the expiry of $4 trillion worth of contracts tied to stocks and indexes. We're going to be watching for that closely. Plus, Adobe, they beat the street with earnings while issuing an upbeat forecast. Revenue came in at $4.8 billion for the fiscal second quarter, while it raised its full-year sales view to around $19.3 billion. That's the higher end of the estimates. The Photoshop maker has been doubling down its AI efforts, integrating the technology into products including Acrobat and Express. This month, the company said it would offer AI tool Firefly to its large business customers. Shares are up over 40% this year. And the big chip makers making some big moves. Intel planning to invest up to $4.9 billion to build a plant in Western Poland. That as the semiconductor giant embarks on a multi-billion-dollar investment push across Europe. Now this is rival Micron reaffirms its commitment to China, saying it's going to invest over $603 million in the city of Xi'an over the next few years. Notably, the U.S. memory chip maker was effectively blacklisted by Beijing in May. Micron told investors that the ban could lead to a single-digit percentage point revenue loss. So we'll be watching that closely.
Well, the only way is up for global stocks, maybe, it seems. The S&P 500 capping a sixth day of gains. The NASDAQ showing few signs of breaking its monster rally, now heading for its longest weekly winning streak since 2019. It's up for 8 straight weeks, by the way. Ben Amons is joining us now, New Edge Wealth Senior Portfolio Manager, Head of Fixed Income and Macro, and Brian Railing, Wells Fargo Head of Global Fixed Income Strategy. Guys, thank you both for being here. Yeah. Appreciate you coming into the studio. So it has been really interesting how we have seen this movement upward in stocks here, especially amidst a sort of confusing environment, I think we could say. Ben, we obviously heard from the Fed this week, and initially the rally sort of stuttered, but it doesn't seem to have fizzled out.
No, not at all. And it's interesting to see that actually the hawks are outweighing the doves this week. If you take Australia and Canada hiking, ECB hiking, and the Fed actually putting a projection that looks very hawkish out there. And yet we're up 3% on the week. So I think what markets have taken is to say, this tightening is going to affect inflation. It's going to bring it really down. The central banks are right. The inflation moving that direction. Their forecast may be met. And I think that's what equity markets in particular are pricing in. That means low inflation is multiple expansion, and that's hard to stop. That momentum will go on top of what you're just describing with this AI. Every news item on AI is additional momentum by the market.
And so, Brian, why doesn't the market believe the Fed?
I don't know. I think the market's just having a summer fling, honestly. We're in a stage right now where bad news is good news is good news. Any type of news that comes out, the market finds the silver lining and it just wants to go up. But, there will come a day of reckoning. It just may be maybe a few months down the road still.
So, Ben, I want to bring you in here, Rochelle here. As you look at this equity rally, then, a lot of people are still staying on the sidelines here. At what point would you jump in? At what point does it make sense to jump in?
I would say, Rochelle, you jump in now, right? If the underweight of equities is so significant, and as I just described, you have this momentum ongoing, then you don't stay sidelined for that reason, because the technicals are stronger, even though that if you look at big tech, that seems to be overbought, as they say in technical analysis terms. It seems that the rally is broadening. I think I really want to describe this too, that the recession is not really happening. Also, the feared liquidity drain that was out news a few weeks ago is not happening either. It's actually the opposite. And I think that's really the message of the Fed currently, that if you have an economy that's resilient and can withstand this higher rate or even higher rates, and take the housing market as a really good example of the rebound that's happening, even though you have 7% mortgage rates, then this is an unstoppable rally for this moment at least. So the technicals are very much behind the market.
Is it though, Brian? It sounded like you think that maybe something could go wrong here. What would that look like? Like, what are the risks out there to the upward momentum?
Yeah, in the very near term, I mean, clearly the market is in a really good mood. But you look out a little further into the fall, perhaps, you still have to have inflation come down. Now it's going to be coming down much quicker just because of the base effect. But to get down to the Fed's target, that's going to be a challenge. So the Fed, I believe the Fed at its word. I believe they are going to hit 2% inflation, and they are going to do what it takes to hit 2% inflation. And that likely means more rate hikes unless something breaks, right? I mean, we did have SVB back, a couple months ago, come out of the blue, a little unexpected. Now the Fed jumped in and took care of that pretty quickly. But conditions are ripe for something to break, but I'm not predicting something breaks,
Why have yields been so range bound, given that, the read is that the Fed is perhaps going to be more hawkish, for example?
Yeah, I mean, if you look at the yield curve, obviously extremely inverted, and more so after this week's meeting. So we have been range bound in a sense, but it's a pretty big range. If you look at 10 years, back in October, we were at 4.25, got down to 3.25. So, that's a lot of price movement. But yes, pretty well behaved. I just think the bond market is trying to figure out exactly how high the Fed's going to go here, and it's just going to bring the yield curve up with it. So if the Fed goes another 50 basis points or 75 or even more down the road, we'll continue to see those long-term rates get pulled up. But that yield curve inversion, that is foreshadowing more difficult economic times ahead. It's the timing that's tricky.
Does the Fed need to be active all the way until that 2% target, or can they get to, say, 3 and see that and say, you know what, now we're just going to let the market and the broader economy, rather, kind of play out and work itself down to 2 naturally?
I don't think so. I think the hawks are in control of the Fed, and they're saying it's not 3%, it's 2%. And just take Chris Waller, he's at a conference in Norway with a speech out, making the same point again of there's not going to be a few regional banks that are going to change our policy. Pretty strong statement, I think, but it indicates that credit contraction is here and naturally should happen if you have higher rates, but it has to be 2% because that's their mandate, right? That's the price stability mandate. And you could argue with that because it's not that simple to get exactly at 2%. It's not that symmetric, but I think for markets what it means is that they've already priced in 2% in the bond market, more or less. So if you keep that stable and you are going to be on this glide path with inflation down, that's your Goldilocks scenario. So again, it speaks to this sentiment in the markets that has caught on to that we're not in a recession, we're gliding down with inflation. Okay, you're having a Fed that will continue to tighten, but it's not going to be any surprise.
Yes, I don't think the markets necessarily believe the 2%, right? Because I mean, there's a lot of people in the markets that are like, the Fed's going to stop at 3, the high 2s are going to be good enough. I just don't believe that.
Well, and why don't they just change the 2%? That's what I was asking over the past couple of days, because it doesn't right now, it doesn't feel like a realistic goal in the short term, although you said you think that they're going to get there.
Oh, I think they're going to get there. This is what I think. There's the disconnect between kind of markets and reality. I just don't think the markets think they believe the 3% is going to be good enough, but I don't think it is. So we'll get down to 3% pretty quick, but that last 1% is going to take a lot of work, a lot more work, I think, than the markets expect.
And clearly, if the markets aren't believing this at the moment, at least from the Fed, and sort of charging ahead, being that the Fed is looking at backwards-looking data, I want to ask you, because when we saw this Carver IPO coming in, sort of doubling on its debut, this idea of pouring into growth stories, do you think the Carver IPO is perhaps an outlier, or does this really signify sort of more risks that people are willing to take? Ben, for you.
It looks to me like more risk for Shell because this was an extraordinary IPO, no doubt. And if you look at that IPO index from the S&P or the IPO Renaissance ETF, it's really ratcheting up quick, and that's because there isn't much IPO volume just yet. It's actually very low compared to a few years ago. That is the effect of the Fed. And I guess that if the liquidity is back in markets, and that's one area that immediately turns on. So it's a good signal in terms of risk-taking. But it is also known that IPOs are about froth. Right? If you're getting overpriced IPOs, then it becomes a frothy situation. That's not where the market is right now, I think. But that is a risk, I think, from here if we get to that stage.
And Brian, what do you think this signals? Same question.
Yeah, I mean, I don't have any comments specifically on that particular name, but in general, I think it just shows that, investors are willing to take a risk. And again, the market just feels good. And pretty much anything that comes out, the market finds a good piece of news in it.
Yeah, it feels that way, doesn't it? You know, with this sort of enthusiasm and I don't know if you want to call it froth that's in the market, but I know we're going to talk more about AI in a minute, so maybe that's jumping the gun in terms of that froth discussion here. You alluded to the fact that we're starting to get some Fed speak now already in the wake of the Fed meeting this week, and it feels like maybe they're going to have to manage around and try and give a little more precision, right, on what we heard from Jay Powell. What do you think the message is going to be? Well,
I think the message was really clear at the Fed meeting. I just don't think the market listened to it. I think they just looked through it. I mean, I think we're going to get a 25 in July, and then we're going to look at the data. And I think it's likely that we're going to see additional rate hikes after that. But it's really data dependent. I do believe the Fed in that. But what do you have to see? You have to see the consumer weakening, right? You have to have people not have confidence in their employment, right? So they stop spending a little bit. You know, until that happens, I think it's going to be really difficult for the Fed to accomplish its goal.
You know, one of the interesting conversations that's been continued in terms of this third inflation wave, as at least one of the economists we spoke with classified it this week, is the profit-led inflation wave that we're seeing. Do you think that's something that's starting to fizzle out? Is it still strong from what corporations are putting forward, at least in their margins that they're trying to preserve?
Yeah, you can pass on inflation, then it's a good thing, right? You keep your margins fat, so to speak. It is to be seen there. I think that we've had an extraordinary period for that reason. You know, if you have inflation ratcheting up to 9%, that only comes off by a few percentage points, and you can continue to pass that on. So you have this unsatiable demand. At some point that changes because, you know, if you take the leisure and hospitality as a really good example of that, people want those services, they want to get out there. I mean, we all do want this and we're willing to pay up for it until a certain point, and then the things change. So I think we're in the stage where the economy is still absorbing the shock from the pandemic in a good way. Until you get to, I guess, just oversupply of these services being too highly priced. And I think we're just not there just exactly yet. One thing you want to keep in mind too is this is a global reopening, right? So China being fully reopened now, that's just still a big wave of demand for services coming at us, you know, if you think of tourism or just in general. So I'll be closely watching this because if that's the case too, yeah, companies can continue to pass on that inflation because, well, people are willing to pay for it.
Yeah, in summary of the leisure and hospitality services, we outside, as the young kids would say right now. Stay with us, both Ben and Brian here. We've got much more to discuss this morning.
Yes, as I alluded to, an AI discussion. It wouldn't be a day if we didn't have one of those. Adobe is the one that is in focus today in that department. The shares are moving higher, up 4.5% after the design software company delivered record second quarter revenue and beat the street's expectations after the close last night. The company also raised its fiscal year outlook and said it saw strong demand across its cloud segments. What's really moving the stock this morning is the AI buzz surrounding the company. Adobe Chief Executive Officer Shantanu Narayan saying in a news release, Adobe's groundbreaking innovation positions us to lead the new era of generative AI, given our rich data sets, foundation models, and ubiquitous product interfaces. So this is, you know, just the latest example of what we have seen in terms of the AI enthusiasm. And it's not necessarily new to Adobe. The company had already sort of rolled out some new offerings here, but it is, again, the latest example of what we've been seeing. What's also interesting when it comes to Adobe is, you know, this isn't one of those sort of bolt-on situations. It seems to make sense if you're dealing with graphic software that you are adding on generative capabilities.
You know, this one, I don't know why perhaps, but for me, I was a little perplexed because it could have been a toss-up. For Adobe and the product and the suite that they have, it could easily be a situation where, yes, you have generative AI that is a net positive for the creator community, but what does that mean for the number of people that would have had to purchase a lot of the suites that they have, whether that be Photoshop, in the past, whether that be how you're doing video editing. And so I guess as long as they're able to show that core customer base that they're able to infuse that within the product suite experience as well, then perhaps it's that net positive on a longer term basis, and that they won't miss out on opportunity. And there is a larger question of whether this is still an acquired or growth story, Rochelle, where we've seen Adobe be able to do that in the past and acquire smaller players that have something to do with a niche part of marketing or a niche part of creative design and weave that into their business. And so that still remains to be seen if they'll have to go out and acquire another generative AI company if they can't do this successfully themselves.
That's true. I mean, they did seem optimistic, at least on the earnings call, on their ability to do that. And when you think about their commenting on the rich data sets, at the end of the day, generative AI, it's about the data that goes into it. So I do think Adobe is perhaps better positioned than others that are sort of tossing AI out there, whereas Adobe can at least build on some of its existing Creative Suite products. So I think it makes sense that investors would be excited about how Adobe is positioned here, because people are really looking for use cases, as Julie said, as opposed to something that you just sort of bolt on because you have this AI buzz all around.
I mean, what's interesting here is they don't need to build their own stuff. They can build on top of ChatGPT, et cetera. Let's bring him back in, Ben Amons of New Edge and Brian Railing of Wells Fargo. And guys, I guess I would broaden it out and ask about AI as a symptom kind of what we were talking about earlier, which is that things feel good right now. I mean, and maybe they feel good for also some fundamental reasons, like a sort of longer trend fundamental thesis around a technology like this.
Yeah, I mean, AI is, of course, all the buzz right now, but AI has been around for a long time. It's just some of the natural language, ChatGPT, et cetera, that has really focused it and been a new innovation. But, you know, I think the market's a little bit ahead of itself here. Is AI going to be a long-term positive? Absolutely. It's going to increase productivity. There's going to be lots of benefits. So is the computer, so is the internet, right? So, you know, it's going to take time to play out. I just think...
Is AI doing anything in the bond market right now? Like, are people playing with it to... I don't know. I don't even know at this point. You know, but you hear about it infusing everything.
Yeah, I mean, there's definitely some experiments with AI in the financial industry for sure. I mean, that's a big use of potential use for AI.
Should I do a bull steepener with it? I don't know.
I mean, go ahead, Ben.
Yeah, you could ask it because, you know, I've used ChatGPT a couple of times on the Fed, like bias, like, you know, and then sometimes it gives you some answer on like, okay, that's a more insightful answer. Some of it is not. There's some shortcoming on it, but I think like systems like Bloomberg that we both use, they're going to roll out Bloomberg GPT. That's actually an acceleration of that terminal functionality, as you remember, Julie.
Very well.
Yeah, you know, as an example. So I mean, I find myself back a bit in the mid '90s as a 25-year-old logging on the internet first time and sitting on the trading floor, getting that new technology. That feels a little bit like this. It's like enhancement of what the previous technology gave us. You can move things faster, can digest information faster, make quicker calculations, and don't have to do different steps to the point of productivity. I think that's the major impact. So I think financial markets take the macro view of it, saying if this is increasing productivity, and there's some studies out there already that's trying to estimate that, yeah, that it means that growth is going to stay a little bit higher at least until this presumptive recession does happen. So I think that's partly the reason why markets are so bubble-ish on us.
Yeah, and I mean, for the productivity element, we've all seen that. If you go into ChatGPT and you put in a prompt that says, hey, come up with a couple topics for discussion for me, it can do that. If I want to, say, create images of all the Supreme Court justices in drag, it can do that via some other type of AI image generator. So the productivity is there, but where and how far are we away from this being a real element that shows up in the economic situation even, where we can say this is the next computer moment, if you will?
Yeah, and it's about CapEx too, right? Investment in that technology, sure. Right? And that's, I think, you think back of what Greenspan, accurately predicted of the productivity boom of the 90s, really was about that he saw like this is going to be leading to a major investment boom. And I think these examples of Adobe or whether you have other companies, yeah, that shows the tentative first stage of that CapEx boom. How far that will go, we'll see, because it, again, back to demand, right? And how much of demand will be there ultimately for AI. maybe people find out that certain things are not that great that people thought it was. Think of ChatGPT, it has its shortcomings. It doesn't give you all the perfect answers. But that technology moment, the iPhone moment, the idea of that we have something completely brand new, that's right now here. That's the sentiment we're seeing in markets.
And so, Brian, I know that you had mentioned that obviously it's still early days, not for AI, but at least for these large language models with generative AI. If you're an investor looking at this space, then, Brian, how should you approach it when you're trying to determine which companies are the ones to sort of get in on versus where you should take a wait-and-see approach?
Yeah, well, I'm in the fixed income guy more than the individual stock guy. But, you know, we've seen a huge increase in the market cap of the large companies, right? I mean, and to me, again, 1,000-foot view, they seem to have a lot of the focus right now. They seem to be in acquisition mode. They seem to be, you know, in a way, trying to be the winners, bullying out the smaller players. But I'm sure there's small plays as well. I'm just not that familiar with them.
All right, we're going to take a pause. Ben and Brian are both going to stay with us, and we're going to move on to another topic.
Absolutely. That's right. After 2 years of negative readings, the Bureau of Labor Statistics, the BLS, as you know them in your hood, they reported a 0.2% increase in real hourly earnings. This gauge shows us that consumers are finally getting ahead of inflation. This, coupled with the resilient labor market, could help maintain consumer demand. We have Yahoo Finance senior columnist Rick Newman with us, who just slid into the chat.
Yeah, I came down. I beamed in.
I like that.
Cool. New technology we have here.
Yeah, that's the next wave after AI. It's transporting.
So help us break this down, Rick.
The most overlooked news of the week.
Yeah.
0.2% increase in real earnings. Did you guys feel it in your paycheck? I mean, did you notice that your paycheck swelled? No, you didn't. I mean, it sounds like nothing, 0.2%, and no ordinary people are going to notice that. But it's an important change in the trend because we've had negative real earnings for the last 2 years. That's because of inflation. Real earnings are pay income when you adjust it for inflation, and that's been negative for the last 2 years, which means people have been falling behind relative to inflation. And I think that helps explain why consumer confidence is at recessionary levels, basically. Even though we have a strong job market and people are spending money, they just feel crappy. And President Biden cannot get his approval rating out of the low 40% range, and I think this is why, because people have been falling behind and they feel it. So we are finally getting a turnaround now. I think it's going to take months of this to sustained for people to feel like it actually is helping them get ahead, but we're getting started.
If the Fed doesn't stomp it out.
Well, of course, but I mean, this is the weird swirl of all this economic data. So, this is secondary to the Fed, but they want to see positive, real income, and their part of that is get inflation down.
Right.
Now,
but that includes wage inflation.
That's right. I know. So,
as they say, it's a blunt instrument.
Right. So, what's the Fed? Will the Fed put out the party? Who knows? I mean, we've been talking about this recession that's supposedly imminent for about a year and a half, and it still isn't here, and it still isn't imminent. So let's just let consumers start to feel a little bit better and stop beating them over the head with the recession that is going to arrive someday.
Well, we are all consumers too, and we would like to all feel a lot better. It is Friday, by the way.
I think it's okay to feel
It's okay. It's all right.
That's my message today.
Well, let's bring you back in, Brian and Ben, on this, because consumers are remaining resilient, but this hasn't eased recession concerns. And the Deutsche Bank chief researchers, they put the possibility of a U.S. recession coming as soon as October near 100%.
Boo!
So, yes, boo them. They're taking away our good.
I'm not buying it. I'm not buying 100. Come on, 100%?
Yeah.
I mean, I've looked back at all the recession predictions.
Yeah.
We've literally been hearing this for a year and a half. That, it seems imminent, and it keeps seeming imminent 6 months down the road.
Well, the funny thing about all of this is, if you were feeling, conspiratorial, you could say, well, this is a conspiracy to get people to slow down their spending. But even if that was the case, it ain't working, right? I mean, so I guess all of this also speaks to the Fed's transmission mechanism and whether it is going to be successful at getting inflation down.
Yeah, well, you got to remember too, when the Fed makes a move, it's 6 to 9 months before it really flows through to the economy. So we have a lot of hikes still to flow through that haven't really impacted us yet. But there's no doubt the consumer is willing to spend. They're willing to run up the credit card, continue to see those levels increase. And, I don't think there's anything that's going to slow them down until they feel uncomfortable with their employment situation, right? If you're worried that you may not have a job tomorrow, that's when you start to cut back. But that could be 6 months, 9 months, 12 months. I'm very confident that a recession's coming. The inverted yield curve pretty much tells you that.
Timing is everything, though.
Timing is everything. The timing is extremely challenging. You never know what the event is that kind of tips. And I would say with the liquidity that's being pulled out of the system, and now, of course, the Treasury bulking back up their balance sheet, pulling more liquidity out of the system, it's not evident until it is evident.
One thing we know is going to happen, though, which is that the excess savings that everybody accumulated during COVID, that is going to run out. So estimates are there's still about $500 billion of money in people's bank accounts that they saved above what they would have saved otherwise during COVID, because no one could go out, no one could spend the money. So one of the things that's been keeping spending solid is people have that excess savings. That is going to run out probably by the end of this year. And so as a cushion, as a spending cushion, that'll be gone. And then that gets to the question, are people going to feel confident enough to run up credit cards, or are they going to say the spree is over?
And I think a huge item that people are not paying a ton of attention to is the student loan moratorium.
Yeah.
They got to start paying again in September. And I have a feeling the people that have to pay, they weren't putting that money in the bank in the savings account. So that's going to take a hit. And then we may get a double whammy. We'll have to see the Supreme Court ruling sometime before the end of June whether there's going to be loan forgiveness there as well.
Rochelle, hit us with the Beltway barometer. I mean, what are the consumers like down there in the DMV?
DC consumers never stop shopping. I just feel like we never stop. I think DC is one of the places where you just don't see that showing up as much. But for people who are wondering in terms of fixed income, when they're taking a look at what's happening with the bond market there, Brian, where are the opportunities then for people who are wondering how long this rally is going to continue in fixed income?
Well, the easy money is just in short-term fixed income. You can hang out there with very little to no risk and clip 5.5%. Maybe even a little bit more than that, depending on your choice of product. What I think for the long term, we got very aggressive buying long-term bonds back in October, around 4.25. I believe the Fed is going to hit in the long term their 2% inflation target. So if I see long-term rates get back above 4, around 4.25, to me that is a great long-term buy, because that is a good long-term real return in my opinion.
Ben, I'm going to ask you to, and then we got to leave it, but you get last word on this. What do you think on that front?
Yeah, there is a total return opportunities, we would say then. Meaning, if the Fed succeeds with that policy to get inflation towards 2%, then long-term bond yields will go towards where the Fed thinks the long-run rate is 2.5%. So think about it, if you just said, Brian, like 4.25, from 4.25 to 2.5 on, say, a 30-year bond, well, that's almost 25% total return. That's, I think, the opportunity, but it will take some time to get there. So because if real spending continues to improve, real incomes continue to improve, productivity continues to improve, it may take some time to get to that sort of outcome. But it does look like that the bond market is giving the Fed a lot of credibility, because there's some risk measures on bonds that we call that term premium. Ironically, that's a negative currently, whereas bond yields are higher, and that difference tells you that the bond market, one, doesn't see surprise from the Fed, believes the Fed is going to hit its inflation target, but also believes that inflation probably really is towards the direction of 2%.
We'll find out.
Yeah.
All right. Thanks, guys, for being here. Really appreciate it. Ben Amons of New Edge and Brian Railing of Wells Fargo. Really appreciate you spending a little time with us on this Friday morning. Have a great weekend, guys.
Thanks.
Thank you.
All right, coming up next, we'll talk about the open of trading and shares of Virgin Galactic, which are soaring today. We'll find out what has investors excited about space again.
Well, it's a choppy environment and a nervous one, and it shouldn't be. I think people are coming to the wrong conclusions on buying a home right now. I think it's the absolute best time to buy a home for a couple of reasons. One, interest rates will come down again, and if you buy it now, you can refinance. And also, if you wait until interest rates come down, even by 1.5 points, I think all hell is going to break loose. Everybody will come charging the market, and you'll be paying another 10% for the house. So there's nothing in my logic that says it makes sense to wait. You ought to jump in now and get the house while you can when there's less competition, and it's still very competitive. Well, what dictates first-time home buyers, which is the inception of any market cycle, is really jobs. And there's been tremendous job growth. There's been very little unemployment. I think there was a survey I was reading last week where they said the typical home buyer is spending another 15% of their income on housing right now to keep up with it. No, I think we have a lot of growth. I think it's very hard to get into the market for the first time, and 2/3 out of all the purchases are all cash. You know that. So it's the rich people are buying now, but I think when interest rates come down again, the middle-class people who want to get their first house will jump into the market with fervor. I think Pittsburgh is a phenomenal market to be buying in. Prices are up about 20% a year. The youth is coming in there, the most educated population. People are real estate friendly. There's new development. You could pretty much live very well in Pittsburgh today.
We just had the opening bell on Wall Street, so let's do a quick check of the markets here on this Friday morning. We are seeing the rally continue here. As we talked about, the Nasdaq in particular up for the 8th straight week and up about 3% on the week. Today, it's up about 0.5%. The S&P opening higher by 0.4%. The Dow up by about 1/3 of 1%. A lot of different things pushing markets higher this morning. I think among them, again, the sort of aftermath of the Fed, Brad, as people still try to digest what the Fed has said. Also, potential stimulus out from China, not hurting matters here and leading to this continuation.
Yeah, absolutely. I was checking my heart rate just as I'm taking a look at this past 5-day activity move here at the Nasdaq Composite. That's up by about 4.5% here over the past 5 days. Here out the gate, up 0.5%. Dow Jones Industrial Average, you're seeing a move higher there over the past 5 days, up by about 1.9%. Here today, 0.4%. So that's in the green. The Nasdaq's in the green, and rounding out the trifecta, the hat trick, the triple double, whatever you want to call it. Call it up for the S&P 500. It's up by about 0.4%. And over the past 5 days, good move there by about 3.4%. Let's take a look at some of the heat maps that we've rounded up for you here this morning as we get trading underway. First and foremost, 11 sectors in the S&P 500. We've got them loaded up here for you on screen. XLB, the lone laggard. It's flat, just barely to the downside here. So that's kind of messing up our Friday vibe here. We'll see if we can get right on the day. And it just did, just swung into positive territory. Didn't like being called out like that. Real estate sector, you're seeing that up by about 0.7%. That seems to be leading the charge, just pretty much fractional gains across the board. We're going to need you to figure out what you want to do, XLB. All right, let's take a look at the NASDAQ Composite. You're seeing some of the major cap tech stocks here. On the week, there's been a ton of activity just around who's going to hit in the $300 trillion club. Well, Apple right now just flat, barely to the downside. We'll see what next week holds in store. But as of right now, hey, if we take a look at some of the market cap here on the day, Apple, all right. Messed up my groove. Still just shy of it right now. But NVIDIA on the day, you're also seeing that percentage move. That's holding on to some gains. It's up by about 1.5% this week. A lot of news on chips this week, whether that's from Micron and Intel here on this Friday, and international moves, and then NVIDIA and also AMD as well, we should note.
Yeah, I think Apple has to get up to around 190, is it maybe, to get to that $3 trillion marker once again. So we shall be watching that threshold. All right, let's watch another stock right now. Virgin Galactic announcing its first commercial space tourism flight. It's spiking the shares by 36%. The space flight called Galactic 1 is set to take off between June 27th and June 30th. Galactic 2 is going to follow in early August. The announcement exciting investors after the company lost over 2/3 of its share value last year from launch delays. And Rochelle, this launch date is pretty much in line with what the company had talked about, but I guess that they're confirming it is seen as a good sign.
It is, and I think they could do with some good news. I mean, they had finished conducting the last of their pre-commercial test flights. I believe that was in late May. So we knew this was coming. Obviously, it's coming up very quickly here. And really, this is a bit of a boon. A lot of us wondering, when we were going to start seeing some of these commercial space flights coming up. And it seems Virgin ahead of the game here. Brad, what are your thoughts?
I mean, I can't wait to be able to buy a ticket to space. But as of right now, those dollars are going to have to go into a house on home. Should I be able to find one and just make sure I save that much. But as we continue to look across Virgin Galactic and how they're going to need to strike the right price among a base of consumers, which is yet to be fully realized and discovered or hit critical mass, we'll see what that looks like in the future. But then also, for the number of launches that they're going to try and do per year, I mean, we're not nearly at even a cadence where we know what that frequency will look like. So any inclination for the company to say, all right, we've got a window that's opened up. As you were mentioning, they said that window opened up in May. And then additionally, now moving forward with flights, the stock is going to be highly reactive on any of those announcements, just as it is today. And we'll see if there's any big names that go on this flight, too. That was all the fanfare when we started to see some of these test flights taking place.
Yeah, we'll find out who has the cash to get on these things.
Well, from outer space, we're going to bring it all the way down to the ground. We're talking iRobot, taking a look at that stock soaring after the UK approved Amazon's $1.7 billion purchase of the company behind the Roomba vacuum cleaner. Now, the Competition and Markets Authority said it cleared the sale after concluding the deal would not put rivals in the robot vacuum cleaning space at a disadvantage. Now, this comes as a win for iRobot, especially after disappointing Q1 earnings and revenues, with sales having decreased by 50% year over year. So this is an interesting one. We've been seeing a lot of M&A at the moment, but the UK has been sort of pushing back on a lot of this. So interesting to see that they don't see that level of competition here with the robot vacuum space.
Yeah, they pushed back, as you mentioned, on a different deal. Well, it didn't have to do with vacuums. It was the Microsoft Activision Blizzard deal. So they kind of bucked back on that. I mean, this one, interesting because you think about the other vacuum players that are out there that also sell into Amazon and what they might try to do in terms of making sure that they are still maintaining their positioning within rankings when people do searches. Because now, if this is a product that Amazon owns, it now becomes a larger issue of, okay, where are we positioning, or where in that marketplace are other competitors' products positioned when people start to do searches on that?
Yeah, it's interesting because the UK authorities did seem convinced that Amazon was not going to advantage the iRobot Roomba products over competitors and that there was enough competition in the market. One of the other areas that the Competition Authority didn't really address, that some critics of Amazon wanted them to, was the data question, right? Another device in people's homes, gathering data on their habits, I guess on their vacuuming habits, among other things. And I know that there were some privacy experts who were concerned over that aspect, but I guess once you've let the horse out of the barn, so to speak, you know, Amazon already has obviously devices in homes. What's one more thing? I don't know. So it's interesting that they were examining it more on the competition grounds and granted it on those grounds and did not as much examine the privacy angle, seemingly.
I'm not gonna lie, I want a Roomba. I just can't use it with my rug, apparently, according to the Google results here. So I gotta find something else.
So you just got to do the good old-fashioned upright. Sorry.
Oh, okay. Well, I guess so. All right. Guys, SoFi shares, they are dropping after Bank of America and Piper Sandler downgraded the company to neutral. Oppenheimer also downgraded the stock yesterday. This is interesting, citing issues in valuation, management, and credit quality. Despite being labeled as a long-term winner, investors will be hoping to see some strength from SoFi's next earnings report here. This was one you flagged this morning here, but it's interesting because a lot of this still comes back to the expiration of the moratorium of student loan payments as well.
Yeah, the stock had surged, right? It had a huge run in the wake of that moratorium, or it's not lifted yet, but we know it's going to be lifted in the fall. That had been an overhang for SoFi, but the stock had run up so much that yesterday we had a downgrade, and then today we have two more downgrades from Piper and B of A, basically saying that it's a valuation call. Most of these calls do have to do more with the valuation than the fundamental case, Rochelle, that we are seeing for SoFi.
It's true. I mean, as we've been noting here, some of the outperformance they did say was warranted, but these valuations going sky high. But you're looking at potentially looking at interest rates at some point declining. I mean, that's going to help with better margins, make perhaps lending opportunities also look more attractive. So interesting to see these downgrades here. But I mean, it makes sense on the back of the fact that the Fed's saying, look, we're still going to have these interest rate hikes coming up, potentially two more at the end of this year. So really sort of a holding pattern here for SoFi at the moment.
You know, my mind immediately jumped to, what does this mean for companies that analysts had come out and said, you know what, this student loan payment that's going to have to be initiated, that's going to impact them. I think of a Target here. I guess more long term, they could still be impacted. But yeah, I checked on those shares. They're still moving lower right now.
Well, Brian Railing was talking about that as well, because it's not lifted. We don't know yet what the actual effect on consumer spending will be. But if I am somebody who has a lot of student loans and I haven't had to pay them for a few years. I've spent that money on other stuff. As Brian said, those people probably did not take that money and put it in a money market account, for example, or in investments. It's likely that they spent it, or at least spent some of it. So now, as they're going to have to start paying it again, that's money that's going to come out of the bucket for consumer spending, as it were.
This feels too much like a personal
Sorry.
attack. We're going to go to
Sorry,
break,
Brad.
everyone. Coming up, we're packing our bags and we're heading to France for the Cannes Film Festival next week. As demand for European travel is rising, so are the prices for a Euro trip. More on this summer travel season when Yahoo Finance returns.
I want a picture of you and Saz at the airport.
Done deal. We can make that happen.
All right.
Tesla up 25% over the last 10 days. In fact, year to date, this stock is up a whopping 108%. Part of this has to do because of AI. Adam Jonas over at Morgan Stanley writing a note recently saying that investors are thinking of Tesla first as an AI company and second as an automobile maker.
The story about Tesla has been about their moat, about their investment in technology, their autonomous driving, how that database really gives them an edge over their competition because they don't want to be valued like GM or Ford or Volkswagen. They want to be valued like a tech company because that gets the stock price higher. If Tesla is an AI story, guess what? That's a bubble story. And so I would just take that to mean, okay, Tesla is going to be part of the next bubble.
The reason why robotaxis could be so transformational is the deals that they've struck with Ford and GM, basically opening the supercharger network, and effectively these two OEMs coming to Tesla and choosing their platform. Elon Musk said on his shareholder meeting, he said flat out, like, we want to be like Android and really open up this software to everybody.
The whole thing that's fascinating to me is the real transformation in this industry where everybody, right? You know, Ford, GM, Stellantis, Ferrari, Volkswagen, they're all leaning into this EV transition. The industry's moving that way. I just think that, you know, it's possible that it might take a little longer than expected to hit some of these forecast numbers that are out there.
So stocks are looking to close out another strong week on a high, but there's a lot of options expiring today. Could that derail us? That's the big question. good person to go to that with is Yahoo Finance's Jared Blickery. He's over at the New York Stock Exchange. He's going to break it down for us. Hey, Jared.
That's right. I can almost see the options floor a few dozen feet away. Let's go to the Wi-Fi Interactive and take a look at the S&P 500 here real quickly. Over the last couple weeks, especially the last 11 trading days, this goes back to the non-farm payrolls, and what I'm writing about in the morning brief is we have just accelerated to the upside, and that is as the rally is finally broadening. But I want to stick with options expiration for a second here. On the indices like the S&P 500 and the Russell 2000, the NASDAQ, those options expire on the open. So that's already done. Now in the ETFs, that's in later in the day, after the market close. It's actually on the last tick, same as individual stocks. Nevertheless, by the end of the day today, a lot of gamma will have rolled off the market. Now, what does that mean? Gamma is something that builds up as the options volume increases, and as dealers have to hedge their positions, let's say they're buying or writing options, they have to offset those. This can cause an immaculate cycle, call it, whereby they're forced to chase the price higher, and that's happened with a number of stocks. Suffice to say, go back to the Wi-Fi Interactive here for a second. This is the sum of the S&P 500 and SPY. That's the S&P 500, the biggest S&P 500 ETF. Gamma, that's expiring within 1% of spot 6 months out. And you can see this peak right here. This is higher or just as high as just about anything we experienced in 2021. And that was at the height of the options and the GameStop frenzy right in there. And then you go back, some of the greatest, I would say, hiccups in the market, in the options market, were actually during the Volmageddon, and you can see a lot of volatility around there. What happens from here? Hard to say, but next week, at least in the very short term, markets should trade a little bit more normal. You're not going to have prices distorted by all these options effects. So that's a little bit of, you can say good news or bad news. If options dealers are having to chase the prices of your favorite stock, it's probably working in your favor. Going back to the S&P, going back to the Wi-Fi Interactive, just want to check the sector action over the last 5 days. Look at that, XLK up 5%, that's tech, followed by industrials and consumer discretionary. Those are a lot of retail stocks. We've seen consumer discretionary in the cruise lines, the airlines, the reopening trade. Well, those have exploded to the upside. And you take a look over the last 11 days, and remember 11 trading days ago, it was at non-farm payrolls when we got those job numbers where I saw good news becoming good news for the first time in a long time. Retail, consumer discretionary, XLY in the upper left corner, that just takes the show up over 8%. So are industrials up 8%, then materials. Tech also in the top row there. So really good to see a healthy mix of different sectors participating in this rally. And finally here, I have one more thing to show. Let's see if I can get it up. May not want to cooperate, but just in terms of the price action of some of the stocks that have led the S&P 500 over the last 11 trading days, what I've been writing about in the morning brief. Cruise lines at the top there, Carnival up about 30%, Royal Caribbean, not actually Norwegian Cruise Line, not too far behind, and then you see other names like Stanley, Black & Decker up in there, so a really broad swath of stocks finally starting to break out here.
Jared, thanks so much for the update there, and we're going to be watching into the close to see some of those ETF options expirations as well. Thanks so much.
Well, summer travel season is in full swing. According to a recent survey from Hopper, 89% of its users plan to travel. Where are they going? Well, that graphic right there tells you Europe is the #1 destination for international travelers. And with increased demand, airfare is the highest it's been in over 5 years. For more on this, we welcome in Haley Berg, Hopper lead economist. Got to tell you, Haley, this is exactly why I did not go to Europe this year, because the airfares were too expensive. But tell us what some of the travel trends regarding Europe are that you guys are watching.
You're exactly right. Airfare is incredibly high. The average ticket to Europe over $1,200 just on average. We have destinations that are well over $1,400 or $1,500 a ticket. But American travelers love those bucket list trips to Europe during the summer. So London, Paris, and Rome are going to be the top destinations this year. Americans are biting the bullet on those airfares. We're seeing incredible demand throughout the end of the summer.
And so for people who want to travel to Europe but cannot pay this eye-watering $1,200 to go to Europe, talk about some of the off-the-beaten-path locations that could also be a good buy.
If you have to go this summer to Europe, definitely consider some of these smaller, less expensive, and off the beaten path cities. Portugal is my favorite this year. Porto, there are a lot of flights from the east coast of the US directly into Porto, Portugal. Very inexpensive, under $1,000 round trip from many airport origins. Also a very inexpensive country to travel within. So when you're thinking about that international vacation, if you are headed to Europe, try off the beaten path, but also consider shifting your travel dates. Airfare for September and October trips to these same popular destinations in Europe is averaging about $500 less per ticket. So it can save you a lot if you can push your vacation out a little bit.
I have a question about Portugal in particular, though, Haley, because I feel like that is the new hotspot. Like everybody's going to Portugal right now. So typically, when you have a surge in popularity for an area like that, I'm surprised to hear you say it's still not as expensive. What tends to be the lag in the airfare and the prices on the ground there catching up when you see something like that coming into trend?
What we're seeing to Portugal in particular is many low-cost carriers are now flying in and out of Lisbon and Porto. That's keeping prices down even as the popularity balloons. So I would expect that we won't see an incredible run-up in prices relative to other cities in the next 18 months. But if this is a region, a country that stays incredibly popular, we might see some price increases longer term. Iceland and Croatia are great examples. They were trending cities in the last, trending countries in the last 10 years or so, had a huge influx of low-cost carriers that kept fares down, but fares are back, really in competition with fares to some of the other major cities in Europe now that they've been popular for more than maybe 3-4 years.
How far in advance should you be booking international travel? I mean, just like general rule of thumb, because I have a friend who did it very last minute this year.
Is the friend you?
So travelers who haven't booked their summer trips to Europe aren't going to want to hear this, but 3 to 4 months in advance is the sweet spot for Europe in particular. If you're headed to Asia, some of those longer haul trips, Trans-Pacific, more like 5 to 6 months in advance. That's why now is the best time to be booking fall trips. September and October prices are super low. They will start rising. So if you're booking a European vacation now, you are definitely paying a premium for your procrastination.
I want to ask you, because we know that the last hot destination was Iceland. It basically promoted itself as saying, look, have your layover here. It was a good way to sort of boost tourism. But then this season, we're hearing a lot about skip lagging and whether or not you should do that, essentially sort of booking your flight and basically not doing the second part of your flight so that you can actually get the better deal on the destination that you land in. Talk a bit about that and sort of how that's playing out this summer as well.
Skip lagging is just one of many ways consumers try to find better prices on airfare. There are definitely some dangers that come with skip lagging. It's not something that airlines typically appreciate. So what we recommend at Hopper is look at things like hacker fares, which are essentially 2 one-way tickets combined to be a round trip or to get you from A to B. It's something that is very common in the airline industry. It's typically easy to get some super low prices, especially on those international trips if you do book one of these hacker fares. And the good news for consumers is you don't need to go out and do the math and create a spreadsheet and figure out the cheapest way to get from A to B. If you use an online travel agency like Hopper, we'll build those fares for you so that you can just book your trip as a regular round trip. We'll let you know that you have multiple airlines or multiple tickets. So I would always err on the side of go with what is easy and cheap, and that would be using an online travel agency like Hopper for some of those hacker fares if they are cheaper than the direct alternatives.
Haley, let's zoom out a little bit because we have seen this strength in travel as one of the continuing bright spots in the economy, right? That this is a place where people are willing to spend. How long is that going to last? Are you guys seeing any sort of indications in your data? You know, we always ask, for example, CEOs of food companies or that make other products. Are you seeing any pushback against higher prices that would indicate a waning in demand? Are you guys seeing that anywhere?
At Hopper, we are not. What we are seeing is deal-seeking behavior. Our users are saying, yes, we're going on vacation. Yes, we're tacking on an extra trip this year. Yes, we're going to spend more than we've paid in previous years. but they're also monitoring prices. They are coming back and checking the price of a flight of a hotel 50% more than they did pre-pandemic, even as their planning window, the time they're spending planning their trip before booking, is shrinking. So we do see price sensitivity, deal-seeking behavior, but it doesn't seem to be slowing down demand. Instead, it seems to be accelerating the ability to go on vacation as these travelers try to tack more days onto trips or slip in an extra domestic trip in the year. So definitely not a slowdown, but some of that deal-seeking behavior that tells us that there is some concern about finances, but it's not enough to slow down this demand for travel.
Haley, I can't wait for like 2 weeks from now, because then we'll get a full quarter glimpse of where we tracked compared to pre-pandemic times. The first quarter of this year was the first time that we had seen TSA travel throughput numbers top a pre-pandemic marker for a comparable quarter. And so that in mind, to what extent is corporate travel a part of this? Is this still largely a leisure or even bleisure type of situation, or is corporate travel, is it back, baby, as they would say?
You know, we're hearing from airlines that corporate travel may not be back all the way, but we have heard estimates anywhere from 70 to 80% of that corporate demand is recovered. But you've nailed it on leisure. We're seeing a lot of travelers either tacking work onto a vacation through the flexibility of remote work, or tacking personal trips onto the end or the beginning of work trips. You know, Hopper users, about 50%, have some level of remote work flexibility, and a large majority of them do plan to work remote, to extend a vacation, or to get an extra trip in this year. So I do think we're going to see blurring of lines where you may be tagged as a leisure traveler, but you are planning to work on that trip, or you're tagged as a corporate traveler, but you're going to add 3 days in your destination city for a little bit of a vacation.
Interesting. All right. Haley Berg, thank you so much for joining us here today. Haley Berg, the Hopper lead economist, joining us to break down all things summer travel, and for those looking to book in October, them too. Thanks so much, Haley.
Great to be with you guys.
And coming up, the Fed paused this week, as expected, but 2 additional rate hikes, they are now on the cards. We dive deeper into the Fed's plan of attack on the other side. Stick around.
Cannes, a destination frequented by the uber-wealthy, located on the French Riviera, is famous for its annual star-studded film festival, but the city also hosts the biggest business gathering for marketing and advertising, Cannes Lions. Heavyweights from Amazon and Delta Airlines to Walmart and PepsiCo strategize, wheel, and deal to get their message to you, the consumer. And just like the film festival, they hand out annual awards for the best in advertising. This year's event comes at a pivotal point in the advertising business. Economic pressures have forced companies to make deep cost cuts, with many of those hitting marketing and advertising budgets. So how are they managing through the downturn? We will explore that with a lineup of CEOs and chief marketing officers look to nail the 4 Ps: price, promotion, product, and place. Another challenge for the world's biggest brands, striking the right tone in hopes of broadening their brand appeal. Some companies looking to expand their customer base have suffered backlash amid a polarized society. Bud Light, Miller Lite, Target, all under fire this year. Companies finding that corporate activism may come with a price on Main Street, but in the spirit of an infamous Nike campaign that positioned that brand for its next leg of growth, are newly vocal companies willing to stand for something, even if it means sacrificing everything. But it's not just viral backlash companies are trying to avoid. They are dealing with a new wave of disruption, the latest technology, privacy laws, AI, and the metaverse. They are transforming how companies connect with us and how we engage with them. We'll ask industry experts what this means for the future. These are just some of the themes Yahoo Finance will explore at Cannes Lions 2023.
Hey there, it's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Rochelle Akufo. We are 30 minutes into trading here on the day. We've got a lot that's moved since we have seen the market open here this morning. First and foremost, we're watching shares of Cava. The stock still rallying after its first full day of trading. Closed the day at $43 a share after listing at $22. Fast Casual Chain says it plans to use the money raised to expand its footprint.
We're also watching Micron, the stock popping as the memory chip maker pumps billions into its expansion. It's going to invest over $600 million to grow in China, despite being effectively blacklisted by authorities. Bloomberg also reporting the business is close to $1 billion agreement to build a semiconductor plant in India as well.
And we're tracking shares of Adobe, the software company stock extending gains from after-hours trading on Thursday. The company raised its full-year profit and revenue outlooks on optimism that its new generative AI features will boost demand.
Well, let's return to the week's big story, the Fed pause, or as it's been widely labeled, the hawkish skip or hawkish pause. The central bank's rate projections suggest 2 further rate increases this year, as Chair Jay Powell highlighted persistent inflation and labor market strength.
The conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time. It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate.
The move, and more importantly, that discussion got a lot of reaction. Economist Ryan Sweet called it a bluff. The Wall Street Journal's Nick Timiraos asked, why not just rip off the Band-Aid and hike now? Yahoo Finance's Miles Udland joins us. And I guess further emphasizing the difficulty that the Fed has, we just got University of Michigan consumer confidence coming in at a 4-month high, 63.9, stronger than economists had estimated. Inflation expectations coming down, which I guess is a good thing. But like all of this strength in the economy, not helping the Fed, Jay Powell sort of saying, skip, I don't mean to skip. because Skip implies they're definitely raising. The next time, like, I don't know, the market did not, or market participants didn't seem to think he did a great job.
Well, I think initially it was a little bit surprising that, and I guess I wrote this 2 days ago now, that there was a consensus among Fed officials that this was the right thing to do. But the more time that goes by, and I think the UMich numbers are interesting today, the inflation expectations coming down essentially speaks to why the Fed would feel it doesn't need to raise rates anymore, because the whole concern about consumer expectations for inflation going higher is that they spend more today, inflationary spiral upwards, which is what you are trying to avoid more than anything as a central banker. But the more I've thought about it and kind of gone through what the Fed now has in front of them, they really managed, I think, to open a wider range of possibilities for themselves than they would have otherwise had. So sure, they took a cut off the table, but you don't need to you don't need to forecast that you might cut rates, because you're only going to cut rates in response to an economy that is materially slowing down. It won't be a mystery. But I think in this current state of play, where you have the economy continuing to be more resilient than people think, the optionality to basically do three things at each of the next four meetings is great for the Fed, I think. If I were the Fed, I would think this is great. I can either hold, raise once, or raise twice over the next 6 months. And coming into Wednesday's meeting, the only option was to hold rates steady because they were already at what they had forecasted the 2023 terminal rate to be.
And so one of the interesting notes within this initial reading here, the preliminary results for June, was as it stands, sentiment remains low by historical standards here as income expectations soften. A majority of consumers still expect difficult times in the economy over the next year. So if you're the Fed, what do you do with that data?
I think with that kind of information, you are kind of compelled to do nothing.
Yeah.
And I think that is, where people said Powell, the reason it was called a bluff, let's say, the Fed's actions on Wednesday, is because the bluff is about the next two hikes. If you look at, information like what you just said, Brad, consumers feeling down about the economy, the layoffs have kind of stopped, but every corporate leader right now has cover to say, like, things aren't really that good. We might do this, might do that. As long as that is out there, kind of in the ether, the Fed has, I think, kind of the downside put, if you want to call it that way, where they don't really need to be more aggressive, and they can say, well, there are some signs that this may come to pass. And that's basically the crux of every economist's forecast for a recession, right? It's going to happen the second half of 2022, then first half of 2023, now second half of 2023. And as long as the Fed kind of still has that out there, I think they, would feel more than content to do nothing.
And Miles, by leaving all these possibilities open, I mean, markets trying to make some sense of it, sort of still optimistic and sort of shrugging off the Fed here. What do you think this means in terms of Fed credibility when you do have so many options open?
Well, I mean, I think that the Powell Fed has earned probably more credibility than maybe some Fed cranks would want them to have earned. But I think when I look at what they did in 2022 is they continued to emphasize that they had one blunt tool, which was raising rates. And they did that quite aggressively. And then they stopped doing that when they felt like they were close to being, quote unquote, the job is done. They've reached the destination or whatever. And so in terms of how much markets are listening to the Fed, I think we can kind of look at the market reaction, like the stock market itself. And I think they kind of believe the Fed when they say we are close to the end of this thing. Now, I mean, there's always a staring contest between AI stocks and Jay Powell, whatever it might be, right? But ultimately, I think it's markets saying that, okay, you guys are probably done. Powell's like, well, we may not be done. But I don't think it's necessarily, Rochelle, to your question, like a credibility question, so much as it is we are in a traditional situation where markets and the Fed are somewhat in tension with one another, which, I think is ultimately what any Fed chair would want there to be. But, we played that SOT. I was actually surprised that didn't get more run, where he said, we're talking about a few years out, because
that's not what the dots say.
Well, but I think what it made me think of, which you'll remember, Julie, was Janet Yellen's first press conference. I think it was in 13 or 14, when she said, we might raise rates in 6 months or something like this. And it was considered like one of the great gaffes kind of in Fed history, because you put a timeline on when you were going to raise rates. And she had to walk that back for like meetings and meetings after that. They went to 8 press conferences essentially as a result of that. But no one really cared that much about Powell having given the year's time frame. I think because his credibility is such that when they move, they will be comfortable moving aggressively and perhaps materially in how they change their forecast.
And I think people have gotten used to, Powell is a little more stream of consciousness. Like, yes, he's deliberate and he's careful, but he also is quite transparent about how they're thinking. One of the things that strikes me about this moment in time is how much argument there is right now about what the Fed is going to do next and how much more is necessary. You have people like Double Line's Jeff Gundlach tearing his hair out and saying, oh, deflation is coming, or Elon Musk, deflation's coming, the Fed has to stop now. I mean, he's been saying that all year. And then you have other people who say, no, they need to keep raising to get inflation back down to their target. Brian Railing of Wells Fargo was just on saying that. And it feels like that there's more of that sort of divergence and dispersion of opinions on that than usual.
Yeah, I mean, I think what has been interesting about the last 6 months, and I think the next 6, maybe the next 12 has more of this in store, is that, long and variable lags. Well, here we are in the long and variable lag. I mean, the banking crisis, right, is essentially an unintended consequence of what the Fed is doing. And so the calls get louder because, you have whatever you want to do, frog in the boiling water kind of thing, right? Like the temperature's been turned up on everything. So let's say you run a company that was venture backed and you would like to make an exit at a certain level, right? Can't do that right now. So you are very angry about what the Fed's going to do. You run a fixed income portfolio, you would like rates to go down because then whatever you've been forced to buy in the last few, years will, you won't be sitting on those unrealized losses, this, that, and the other. But I think we're at this point in time when obviously people's views on the Fed are mostly about their priors. If you run a stock portfolio, you have a certain view, bond portfolio, another view. If you're a strategist, another. If you run Tesla, a third. But ultimately, when you get to this moment, those priors could not possibly be stronger in coming into your view about the Fed. And so I think that is, to your point, Julie White, the rhetoric feels a little bit hotter.
Yeah, everybody talking their book. And
yeah.
Yes, exactly. All right. Thanks, Miles. Appreciate it.
Well, Fed speak takes on an extra importance in the weeks to come. We are monitoring some this morning as well. Richmond Fed President Thomas Barkin saying he's, quote, comfortable doing more if incoming data doesn't show weakening demand for goods and services. Fed Governor Chris Waller also making headlines on credit conditions and the state of banking. Waller says during remarks in Norway that he wouldn't want to alter policy because of a few banks, adding, quote, while lending conditions imposed by banks have tightened since March, the changes so far are in line with what banks have been doing since the Fed began raising interest rates more than a year ago. So joining us now, we've got Jose Torres, who's the Interactive Brokers senior economist. All right, Fed speak galore, Jose. What do you extrapolate from what we've heard just this week?
Thanks for having me, Brad. Well, goods and commodities have been experiencing deflation, and that's contributed to lower year-over-year readings on CPI, but services remain red hot. Core CPI came in above 5%. We added over 330,000 jobs in the month of May. Wage gains continue strong, and services make up most of the economy. So if services continue to come in hot, then further monetary policy restraint is going to be needed by the Fed. In fact, most participants expect 2 more rate hikes this year. Some even went as far as to say to go over 6%. And services are very tough to bring down. It's not like goods and commodities, very labor intensive. That's a long process. Also, on the commodity side, Russia's invasion of Ukraine occurred a little more than a year ago, and that really contributed to a lot higher gasoline prices. A lot of those base effects and why we're seeing lower year-over-year readings now is because of that differential. That's going to fade about late summer. Also, today's consumer sentiment number, a lot hotter than expected, big improvement. Whenever you have a risk-on rally on the Fed, that tends to loosen financial conditions. Things like oil prices go up, bond spreads tighten, and that in this cycle, like in July, like in January, leads to a new leg in inflationary pressure. So I think the messaging from the Fed going forward here is going to be very important.
And you mentioned a number of contributing factors here to the Fed's decision. As we look at especially the US labor market, what needs to happen there, do you think, before you think the Fed will be satisfied?
Unfortunately, you're going to have to see the unemployment rate go up. It's already gone up 30 basis points from the low. Historically speaking, every time you had a 50 basis point increase, you've gone into recession. This is a little different because we're coming off a really low level. But I think you'd have to see the unemployment rate probably 4.5 to 5 to get inflation maybe at core PCE, maybe at 2.9, 2.8. which would then be a level where the Fed would still probably have to remain at whatever rate they're at and wait for that rate to come into the low twos and then maybe start cutting.
Jose, what's the most important piece of data that you're going to be watching over the next month? Is it going to be sort of the traditional PCE, or is there something that you think isn't getting enough attention than it should be?
Well, I'm going to be looking at the PCE. I'm also going to be looking at jobs. I'm going to be looking at CPI. Also going to be looking at what's going on with the banking sector, right? You guys were talking about this earlier and how lending is progressing. In lending, you had an initial credit crunch around April following the regional bank debacle. But since lending and banking has been operating under pretty normal conditions, but there's still about 30 banks that are problematic. So I'm going to be watching those statistics to see how much more tightening does a potential crunch in lending give space for the Fed to not have to go maybe as high as they want to.
If, like many bank executives have estimated, we hit a Q3 2023 recession, how much additional tightening do you think the Fed is going to believe that they need to do?
Well, Brad, I think that if we do hit recession in the second half of 2023, I think the Fed can probably stay at whatever rate they're at. By then, core PCE will probably be down to 3% because that'll cool a lot of the services inflation. And then in early of 2024, the Fed can probably start cutting pretty aggressively.
Jose, thanks a lot. Good to see you. Jose Torres is Interactive Brokers senior economist. Appreciate it. Coming up, the collapse of regional banks has spurred senators to unveil a new bill that could empower regulators in the wake of the crisis. We'll talk about what they are proposing to do when we come back.
News out late Thursday put Federal Reserve Bank of Atlanta President Raphael Bostic in the headlines, and not for the reasons you might expect. Taking a look here, we see, according to the financial disclosure forms, Bostic's money manager bought and sold shares of 19 exchange-traded funds ranging from $1,000 to $50,000 US during the FOMC blackout period in May of 2022. Joining us now to discuss is Punchbowl News financial services reporter and author of the Vault newsletter, Brendan Peterson. So, Brendan, I want to get your thoughts on this at the moment. Obviously, something that we've seen Bostic under scrutiny for before.
Yeah, thanks for having me, Rochelle. This is not a good look for anyone at the Fed, unfortunately, but we have seen the Fed weather this kind of scrutiny in the not so distant past. And this is ultimately like kind of a smaller deal than the string of scandals we saw in 2021. Obviously, Bostic is a member of the Federal Reserve Board. He is not currently, however, one of the Federal Open Market Committee's voting members. He is not deciding monetary policy these days, but he is a voice in the room, and obviously he has information that members of the public might not have. So it's not a good look, but when you're thinking about how DC is going to respond, it's a little bit hard for me to see it moving the needle. There was a whole lot of controversy around the stock trades involving former Fed presidents Rosengren and oh my gosh, his name is escaping me. I'm sorry. The Kansas. I'm not going to try to guess. Long story. Thank you. Those were pretty bad and pretty flagrantly poorly timed as far as political optics go. I think we've already seen this bonfire in DC burn, and there's a little bit of tinder left there. We're going to see probably some criticism from progressives like Senator Elizabeth Warren and others like Senator Rick Scott, a Republican who has teamed up with Warren in the past to pursue some Fed accountability legislation. But big picture, it's hard for me to imagine that we're going to see too much of a reaction here.
Okay. Well, why? I mean, I guess there's just so much question around why there are so many legislators, so many people in positions of power, either elected or put into those positions, appointed by the staff or the president himself, that are allowed to have different type of regulations or just trade freely, more freely than a lot of other people who work in these industries even. And they're the ones actually pushing not the agenda, but they're the ones maintaining policy.
That's a great point. Here's what I'll say. I mean, to a certain extent, it is a matter of degree. These trades from Bostic are just a sort of a lower level concern than those that we saw in 2021. And this is on the heels of the Fed actually instituting a bunch of new rules that prohibit these kinds of transactions, to be fair, during the blackout period when the FOMC is voting. If you look at the stories that have come out, it seems pretty clear that the Fed officials and Bostic has been messaging that, look, we didn't actually know that money manager transactions like this were covered by the new rules. Call it a miscommunication, call it whatever you want. It's just a little bit smaller of a deal, but I really don't want to discount the public damage that this will continue to inflict upon the Fed. The Fed is by no means like in the hottest water right now that we've seen, but it's certainly not in the plummest of positions either. There are a number of legislative efforts out there, like I just mentioned, to encourage some better transparency and accountability at the Fed, introducing a newly independent inspector general to police the Fed's behavior. These are all things that could make the Fed's life a little bit harder. And it only takes so much controversy to get Congress more and more involved. But the other side of the coin here is that it generally takes Congress in a crisis to get lawmakers to act. And we're just not there yet. It is an unfortunate symptom of the way in which our government works, but we're not at that crisis level yet.
Well, guess what? We did have a crisis in another area, Brendan, that you're also taking a look at. And that, of course, was the crisis surrounding SVB, the sort of mini banking crisis, as some have termed it. And there, because something actually did break, now Congress is stepping in to try to do something about it. In this case, clawing back some of these executives' pay. This was something that was sort of talked about in the wake of it, but now it looks like there's actually action. Tell us about it and how likely that is to get through.
Yeah, so the Senate Banking Committee and its chair, Sherrod Brown, and the top Republican on that committee, Tim Scott, announced that they have a deal to introduce the first really meaningful guardrails or curbs on banker behavior since 2010, and that is the Recoup Act. It's all about recovering executive compensation at banks that have failed. You have to remember, when you look back at Silicon Valley Bank's failure, the controversy was partly how quickly it failed and how badly it managed its interest rate risk. But the other side of that coin, and what lawmakers really remember, is the stock trades, the very lucrative stock trades that were technically scheduled in an orderly fashion by executives, but they were pretty high level stock transactions and only scheduled a couple of months out before the bank ultimately failed, a period in which the bank executives knew that Silicon Valley Bank was in trouble. So, long story short, lawmakers are interested pretty keenly, and have been for a while, in introducing some kind of guardrail or curb on that kind of behavior, on making it harder for bank executives to carve out or kind of craft themselves a golden parachute before their institution implodes, especially when they know it's on the brink of doing so. This is a pretty interesting bill, and I think it's got a pretty good chance of finding meaningful bipartisan pickup in the Senate. And so we're going to be tracking it very closely.
And one of the pushers for this bill, Senate Banking Committee Chair Sherrod Brown, said Americans have watched executives take their money, run banks into the ground, and get away with it too many times before. But is taking the pay angle, is that the best way to actually get accountability in this sort of situation?
You know, that's a great question. We have talked for years now, really a decade, about like the best way to police banker behavior. Obviously, a lot of things went wrong in 2008, 9, and 10, and not many bankers, if any, went to jail for crashing the American economy. Today, we are in a different kind of crisis. It's a little bit less existential, and the reforms we're going to see are going to match that. They are going to match the moment. And to be clear, financial services legislation is among the most difficult types of packages for Congress to pass at any particular time. I mean, like, legislation is hard in the best of times. Financial services legislation is tough because the banking lobby is tough and the issues are technical and don't exactly carry a lot of salience for the American public. This is a long way of saying that these curbs on incentive pay, let me lay out that point a bit more clearly. The Brown-Scott package, the Recoup Act, is focused on incentive-based pay. It does not include salary. The important thing to note here is, as many of your audience members probably know, a lot of bank executives, especially at large banks, get the majority of their compensation through stock incentives, bonuses, and other things that aren't actually tied to salary. I think Jamie Dimon's salary is something near $35 million. Sorry, his compensation in 2022 was close to $35 million. His salary was only 1.5 of that total. So, bearing in mind that this is a little bit more limited than other bills that are in the mix from progressives, this is a pretty meaningful bill, and it is something that could, in theory, change banker behavior. If I had $30 million coming to me, I would think a little bit harder about just how carefully I am managing the risk at my bank.
Indeed. Hopefully I get to that point at some point. A big thank you there to Brendan Peterson, Punchbowl News financial services reporter and author of The Vault Punchbowl News newsletter. Thank you for joining us this morning.
Thanks so much.
All right, coming up, mortgage rates continue to come down, but low inventory numbers could mean more bad news for buyers. We break down the latest housing hurdles on the other side. Stick around.
Tesla shares are higher today, bouncing back off of 2 straight days of losses. They're up by about 2% right now. The EV maker saw an impressive 13-day stretch of gains that continued into the start of this week and now sits at over 100% higher year to date. Tesla investor Ross Gerber joined our afternoon show Thursday and was not worried about giving a little back this week. Take a listen.
I'm certainly not sad when you own 420,000 shares of Tesla that have it, go up substantially and make my clients, I don't know, $50 million, pretty happy. So, just to be clear, I didn't want any change in Tesla's management. I wanted change in Twitter's management, which is what we got. And by getting Elon back at Tesla and all the moves they've made just in the 30 days since Elon's really been refocused on Tesla, with signing up the entire world to the Tesla charging infrastructure, for example, and having a very, very positive meetings in China, we just have seen full-fledged how Elon's focus makes such a huge difference in the results. And the stock market has responded, and institutional investors have come back into the stock, and now we're back to the valuation that Tesla deserves.
So, Ross, Diane here. With regard to both of you, had been bullish on Tesla way before the rest of the market has caught up. But previously you were pushing for a board seat. Are you happy with how Tesla is being run now?
Well, I mean, pretty much everything I was pushing for, they've done. So, yeah, I'm thrilled. Once again, Tesla was never really against any of the ideas that I was presenting. It was really just Elon. And so I think there was just a period of time that it took for several of these things to sort of percolate into his mind, into existence. And now things are moving in very much the direction that I had hoped. I feel a lot more confident about the succession plan and management. The changes in the board with JB Straubel, I was very much for. So I'm happy to have JB and Tom Zhu on the board, which really represent operational, players for Tesla, but also just the investor day I thought was super illuminating, followed by a shareholder day that was also very illuminating to what's happening with the company and their focus. So when you look at Tesla as a whole, obviously there's many challenges they face over the next year, but a Cybertruck launch imminent, and the economy hopefully looking like we're through the worst of it, and of the rate cycle hike. So hopefully we won't have a recession, and going into 2024, you have to be very bullish on EV makers like Tesla.
We've heard some on the street call out and say that Tesla is now an AI play. Do you believe that to be true? And has Tesla disclosed enough of how much it's willing to spend on artificial intelligence at this point for you?
Well, it's really nice that everybody's into AI, but this has been going on for a long time. AI development, NVIDIA is another top investment in my fund, GK, along with Tesla is our top investment. And so it's been a really good year for us at GK. But, when you look at Tesla, it is an AI company where its solution, it's not only an AI company, but its solution is autonomy or having cars drive themselves. So this is a much more difficult AI solution than, let's say, generative AI, getting it to tell you, how many, stocks are in the S&P 500 or something, which is 500. So, it's kind of like, the market's finally realizing the full value of the software that they've been developing for a long time, that a lot of people have been saying is going to be incredibly valuable. Now I think the market's starting to say, hey, you know what? These cars do drive themselves, and that could be awesome.
You mentioned the Cybertruck earlier, but that has been delay after delay. Is it ever going to come?
Well, we don't look at Tesla timelines as delays. That would assume that the original date was actually real. So we look at Tesla when they set timelines as really goals. So they haven't achieved their goal in reaching production as quickly as we had hoped, but they're certainly reaching it now. So we're now at the beginning of, can they make these in scale, and how much pain will they go through making these in scale? And we'll see in the next probably 3 to 6 months how successful they'll be at scaling Cybertruck production. So we're hoping for the best. And I was just in Austin, and they're employing incredible new technologies to build this truck. So it'll be quite a challenge. So it's great to have Elon back on the factory floor, really working at Tesla.
All right, that was Ross Gerber there from Kawasaki. Well, in a surprise executive shakeup, Disney announcing late Thursday that CFO Christine McCarthy is stepping down. Yahoo Finance's Alexandra Canal is following the story and joins us now with the details. Hey, Ali.
Hi, Rochelle. And that's right. Another bombshell shakeup in the C-suite for Disney. And this is a big one since Christine McCarthy was at the company for 8 years. She's long been looked at as a really loyal confidant for current CEO Bob Iger. The company saying she's taking a family medical leave of absence. In her place will be Kevin Lansbury. He currently serves as Executive Vice President and CFO of Disney Parks, Experiences, and Products. Now, Lansbury will serve as interim CEO until the company can find a permanent replacement, but McCarthy will be very involved in that process. She will stay on as a strategic advisor and will assist in the process of identifying and onboarding a long-term successor. Now, we did hear earlier this morning from Wells Fargo media analyst Steve Keyhall. He wrote in a note to clients that this presents yet another wrinkle for Disney and especially Bob Iger, who has been really trying to reshape this company since he took over that CEO role in November. Since that time, we've seen massive cost cuts at the company with 7,000 jobs eliminated. That's part of the broader plan for Disney to slash $5.5 billion worth of costs over the next 2 years. And this all comes down to profitability. We've seen Iger work really hard to establish new types of revenue streams like Disney's ad-supported tier. We've also seen price increases across the board to help pare some of those direct-to-consumer losses and lift metrics like average revenue per user. But all that being said, we still have a very bumpy road ahead. Keyhall saying that the back half of 2023 will be particularly challenging for Lansbury since we have a softening in parks growth due to inflation. We have a murky timeline for DTC margin improvements. That's one of the bigger stories heading into the back half of 2023. And then we also have that minority stake purchase of Hulu. What are we going to do with ESPN and bringing that over the top, which is something that a lot of analysts said that Disney should be working towards, and Bob Iger has hinted at that as well. So these are all overarching challenges that any CFO that steps into this position is going to have to face. We'll see who comes out on top in this search, but right now, yet another challenge for Disney, which has been challenged for quite some time.
Indeed, coming into a complex environment, that new CFO, whoever they may be. A big thank you there to our very own Ali Canal. All right, coming up, mortgage rates continue to come down, but low inventory numbers could mean more bad news for buyers. We break down the latest housing hurdles on the other side of this break. Stick around. The National Federation of Small Business came out with their May report on the state of small business in the United States on Wednesday. The NFIB's optimism index increased 0.4% in May to 89.4, marking the 17th consecutive month below the 49-year average of 98 points. Now, small businesses cited inflation as their primary problem to keeping their businesses afloat. Joining us now is Comerica Bank Head of Small Business Banking, Omar Salah, to discuss this more. So, Omar, talk about the key findings from this report and what stood out to you, especially as we're now after 10 hikes from the Fed at this point.
Yeah, great. Thanks so much for having me. Good morning. A lot of economic data out this week. We saw interest rates, we saw inflation, but the one, as you mentioned, what we pay particularly close attention to here in small business is the NFIB survey. So it really depends on how you read it. There's lots of headlines you can look at that will say that the NFIB optimism survey edged up this month, which it did. On the other hand, you'll also see, as you stated at the top, that for the 17th month in a row, small business owners are reporting lower optimism. So, and both are true. The small business optimism is down. It's below the 49-year average. The customers that we talk to indicate that inflation is still their highest concern, and that's been pretty much consistent for the last year and a half, either inflation, labor shortages. And so that's a consistent theme. I think what we've also seen too, and what's interesting to note, is that the net percent of small business owners that have been raising their prices, that actually came down by 1% this month, and that's the lowest that we've seen since March 2021. And a part of that, and with the customers that we've spoken to about that, they've given lots of different reasons for really how they're managing prices. And one of those is one of the reasons of slowing the pace of their price increases right now is really trying to drive sales volumes during the busy summer months. So that was an interesting thing that we saw. Another one too is, despite elevated interest rates, an increasing number of small business owners are reporting an increased need for capital. So 58% of customers that are owners, that reported in the survey said that they are expecting capital expenditures in the next 6 months. So that includes, looking for new equipment, buying vehicles, expanding those facilities. And what we're seeing is highlighted in our loan demand. We continue to see small business owners need credit and need access to credit, and that's been consistent from what we saw in the NFIB this week.
Hey, Omar, it's Julie. The question is whether they can get that credit, right? I mean, they have all these plans to spend, they want to borrow money, but we keep hearing that credit conditions are tightening. Now, I presumably you can just speak for yourselves and not speak for the wider world, but are you guys tightening your standards here?
No, and I think really the noise around credit tightening is real in some pockets of the economy. And really what we are telling our customers, and really what we're highlighting, is to really build that relationship with your bank. Banks today need to be selective with where they put capital. And I think what we are advising is stay close with your customers, stay close with your bank. We really like to see those robust relationships with our customers. In terms of credit, we just launched this week, for example, a brand new access to capital program for small business customers and small business owners to really get access to capital quickly to owners. So I think it really depends on where you are, what level of business we're talking about, the micro small business up until the large corporate mid-market.
What is the reality of how tightening credit conditions or financial conditions for small businesses could pass through to the employment situation here in the U.S.?
I think what we are really helping what we're guiding our customers on really is making sure that you're preparing for the future and making sure that you're preparing yourself if credit conditions do tighten across the industry. And so what this means is, although borrowing costs may be elevated, most likely through the end of the year, we're making sure that our customers are managing their cash flow, they're managing their excess liquidity, they're ensuring that they are getting their financial house in order. So for example, we're advising our customers, make sure you build up and assemble at least a 6-month cushion of operating expenses. That can be a combination of cash and working capital. If you have excess cash reserves today, park it in a high yield savings account so that you can use that for a rainy day, like making sure that you're jumping on opportunities. Review your balance sheet. That's something that we talk about all the time. Make sure that you're looking for ways to tighten up. Do I have older receivables that need to be collected? Am I maximizing all available payment methods through my site? You see those little pay buttons on the e-commerce site, the Apple Pay, the credit card, the PayPal, the Zelle. Make sure you have all that. I think furthermore, when we talk to customers about credit and the macro economy, make sure you're reviewing your pricing. I think that's a big thing, really margin management. Am I realizing a positive margin with every customer? Am I losing money on certain clients? Am I taking advantage of market research tools? There's lots of tools out there that exist for small business owners to really help them compare performance against other industries and assess pricing. We just launched a tool earlier this year called Size Up. It's a tool to help small business customers really harness the power of big data and get free market data. So I think what we're really telling, I think that the punchline here for our customers and for the small business community at large is stay close to your bank, make sure that you are in the free time that you do have, which small business owners don't have a ton of, make sure you're reviewing your pricing, make sure you are getting your financial house in order.
Omar, thanks so much. Omar Salah is Comerica Bank Head of Small Business Banking. Thank you.
Thanks so much. Have a great day.
Stick around. We got much more Yahoo Finance coming up when we return. If you're feeling the pinch of higher rents, you are not alone. While rents are finally showing signs of cooling, prices do still remain high. Typical rents for the month of May reached $2,048. That's up 4.8% from a year earlier, according to Zillow. And Skylar Olson, Zillow's chief economist, is joining us now. Skylar, we've talked a lot about home prices, purchase prices, but we got to talk about rents as well. Obviously, this is a big part of the economy for people who don't own homes. What's the outlook here for rental levels?
Yeah, well, when we're looking at the rental market right now, especially depending on where we're looking, you're balancing a few things. We had a lot of migration over the course of the pandemic, a lot of reasons to move. That's probably starting to slow down. We've also seen some areas that have delivered a lot of new apartments. Construction in the multifamily space was very hot and heavy over the course of the pandemic as well to kind of meet that need and meet that demand. So now where we're looking, there are areas where rent continues to be soft and even is possibly falling, on a month-per-month basis. But that is more and more rare as actually we start to see things in the rental market heat back up. It's softer than, say, a pre-pandemic month, but certainly much more pressure than, say, 5 months ago. Now, when we're looking at that and we're trying to understand, what is happening, there is a headwind to the rental market from the mortgage rates within for sale, as we just have a big buildup of people needing homes. This is a massive generation of millennials that are putting pressure on the market. Just to put a number in your mind here, if I think about all the households that are living within, families, individuals, and couples that are living within other unrelated households, you're looking at 3.4 million. That's a lot of underbuilding. So the fact that we continue to see pressure come back on rental markets, softer than pre-pandemic for sure, but still rental price growth that's on par with a pretty steady growth.
This is almost the second day in a row where I'm summoning Jimmy McMillan into the conversation because the rent is too high. At the end of the day, Skylar, when you think about what type of capacity needs to be brought online, what are some of the time markers that you would be looking at?
Yeah, in terms of time markers. So you mean like when we need these kinds of things? I mean, absolutely right now there's an emergency for many people. If we think about like what it means at a household level, then I'm going to talk about the typical household. So for many households, this could be much worse, right? Over the course of the pandemic, you might expect that rent would take 3% more out of your paycheck every month. Now you're also dealing with general inflation at this time. So households are probably finding it increasingly difficult to save. That puts them at financial instability, especially if you're expecting to go towards, say, a recession, or you might be a bit more concerned about job loss moving forward. So, in terms of the needs for a break to American households, the time is most certainly now. In terms of timing, like how long we might be in this crisis, we inherited it, in the beginning of the pandemic. It was here, we were already talking about it. And then in terms of moving forward, we might expect to see a lot of pressure on housing for the next decade when we talk about generational flows.
And you note this less competition for rental units on the market as people do sort of tighten their belts, perhaps taking on a roommate, trying to do other things like that. So at what point do you see that also then affecting rental prices? Will they start going down then as more people start doing that?
Yeah, I mean, I think what's happening right now in different rental markets, there's actually some unwinding probably going on as we start to see new supply. But a lot of that new supply was in places where we were seeing a lot of good growth, inflow. So when we think about what, metros are receiving a lot of inbound population, those areas are often the places where rent is continuing to grow and people continue to have to pursue strategies like that, right? That $3.4 million number that I mentioned, by the way, not dollars, 3.4 million families or couples or individuals that are living within other households. So say doubling up with a non-relative, those are non-relatives. There are plenty right now, and we saw over the course of the pandemic, this surge of people that go back to live with family, of course. So the boogeyman in every boomer's basement is their, millennial adult son, right? Just kind of saving up to get financially stable. And potentially saving up to try and enter a for sale market that is also increasingly challenging, especially at the lower affordable end.
That is an amazing image, Skylar. I want to ask how all of this feeds into the big picture and the Fed's inflation data that they track, right? Because we talk a lot about so-called owner's equivalent rent as a proxy, right? But here's actual rents that we know what's going on with them. So it sounds like that this is not going to be something that helps inflation decelerate in the near term.
Well, I look at this every month as something I get very excited to refresh, this graph that I track that looks at that month over month pace within the shelter components of CPI, both, for renters and owners equivalent rent. And I look at that month over month pace of our Zillow observed rent index, which, as you mentioned, tracks real asking rate rent. So it does not include concessions. So we do, other analysis on that to see there are absolutely places that are offering more concessions, but market rate rent, we did start to see those shelter components of CPI start falling at around a year lag after Zori hit this fever pitch, towards, the fever was kind of towards the very beginning of 2022, end of 2021. Once that fever kind of broke on that rental market, 10 months later, you see those shelter components of the release market, which dominates the CPI measures that are across the full housing stock. So, okay, what do I expect today? If I look at those month-over-month shelter components, we're about less than halfway back down to, say, a pre-pandemic pace in the release market. We are softer than pre-pandemic in those asking rate rents. So I think that's a good sign for the overall general inflation that the shelter component pressure is easing. It's not going to be a source of incredible softness in general prices, but it is easing relative to those pandemic, highs and heat. And that should help the release market continue to soften down, but maybe more slowly than we wanted.
Really remarkable analysis. Skylar Olson, Zillow chief economist there. I think we all hope that the rent prices come down. We will see in the near future. Yes, fingers crossed, indeed. And switching gears here, everyone. We got to talk about this. Big news coming out of the sports world. Michael Jordan, the GOAT, is finalizing a sale of the Charlotte Hornets, ending his 13-year run as majority owner. The sale, expected to be finalized in the coming days, is led by a group that includes Gabe Plotkin, who is already a minority owner with the Hornets, and Rick Schnall, who is a minority owner with the Atlanta Hawks. Jordan will continue to oversee basketball operations through next Thursday's NBA draft and the start of free agency on July 1st, and is expected to keep a minority stake and a presence with the franchise, according to ESPN.
Well, Beyonce kicked off her Renaissance World Tour with a bang. The superstar is getting blamed for bumping inflation in Sweden. Tens of thousands of fans rushed to Stockholm last month, raising hotel and restaurant prices. Danske Bank's chief economist said the hospitality sector surge is part of the reason why inflation increased by 0.3% from April to May. Queen Bee has many talents, but is market-moving power one of them? Some are not convinced. Yeah, just to be clear here, an economist at Danske Bank, which is one of the Nordic banks, looked at the inflation data, which was up 9.7% year over year in May, which was hotter than expected, and said, well, maybe it's because all these people came to Sweden and pushed up prices. I was looking at the Swedish inflation data, by the way. It peaked at 12.3% year over year. That was in December, and it has been decelerating fairly steadily since then. Yeah. But 9.7% is still high. I don't know. You look skeptical.
I'm just skeptical that you can place the entirety of the blame here on Beyonce. There's a world tour that comes to town, and sure, you're looking for a scapegoat, but Queen Bee ain't it. And I think the Beehive will quickly come to her defense on this one. Rochelle, I don't know if you got tickets to the concert.
I didn't, but I remember looking at tickets in Europe because it was much cheaper to fly there and pay for tickets in the good seats in the risers than it was to just go down the street in Maryland and watch her come and perform. But I do think it's unfair to what they're calling this Beyonce blip, or Bayflation, as I believe you called it before, Brad.
Oh, wait, don't put that on me. I said Live Nationflation.
Oh, there you go. Live Nationflation. Yes, Bayhive, please do not come for Brad. But yeah, May inflation was actually down month to month from April's 10.2%. So I think maybe he did it for a little bit of headlines here, but no, I'm not blaming Beyonce for this. Blame Live Nation. You make us have to travel to get these cheaper tickets, so that's not on Bay.
That's on facts.
Yeah, exactly. All right, that'll do it for Brad and I. Rochelle's got you covered on the other side of the break with more market action and a look inside an accessory dwelling unit. What the heck is that? It's the new trend that's providing big returns for homeowners, particularly in the West and in some states in the South. You can catch us back on the air Tuesday morning at 9 a.m. I'll be here. Brad, he told you, as you saw, he'll be at the Cannes Lions, as we say, Cannes Lions Festival of Creativity. He'll be in France.
What in the Maryland was that?
I don't even know. I speak French, and even I can't figure out how to say Cannes properly.
Yahoo Finance, Cannes Lions.
Rochelle will be right back.
Well, it's a choppy environment and a nervous one, and it shouldn't be. I think people are coming to the wrong conclusions on buying a home right now. I think it's the absolute best time to buy a home for a couple of reasons. One, interest rates will come down again, and if you buy it now, you can refinance. And also, if you wait until interest rates come down, even by 1.5 points, I think all hell is going to break loose. Everybody will come charging the market, and you'll be paying another 10% for the house. So there's nothing in my logic that says it makes sense to wait. You ought to jump in now and get the house while you can when there's less competition, and it's still very competitive. Well, what dictates first-time home buyers, which is the inception of any market cycle, is really jobs. And there's been tremendous job growth. There's been very little unemployment. I think there was a survey I was reading last week where they said the typical home buyer is spending another 15% of their income on housing right now to keep up with it. No, I think we have a lot of growth. I think it's very hard to get into the market for the first time, and 2/3 out of all the purchases are all cash. You know that. So it's the rich people are buying now, but I think when interest rates come down again, the middle-class people who want to get their first house will jump into the market with fervor. I think Pittsburgh is a phenomenal market to be buying in. Prices are up about 20% a year. The youth is coming in there, the most educated population. People are real estate friendly. There's new development. You could pretty much live very well in Pittsburgh today.
In our final installment of Real Estate, the New Reality, we're taking a look at the issue of housing affordability and how one unique class of homes are addressing the issue. They're known as accessory dwelling units, or ADUs for short, and they're being developed at a rapid rate across California. Akiko Fujita joins us from Los Angeles outside one of those ADUs. Hey, Akiko.
Hey there, Rochelle. Well, you said those three letters, ADU. That has become a critical part of the real estate conversation here in California. And put simply, they are backyard units that function much like a single family home. We are actually inside one here. This used to be a 2-car garage, and the homeowners have converted into a 500 square foot space. You see, we've got a kitchen here. You walk over to the corner. We've got the bathroom. And then I'm going to give you a quick tour on the other side here, because there is a bedroom also attached to this unit. All of this done in the backyard here. And the reason we are seeing so much growth in these units is because of a law that changed back in 2017 here in California, legalizing the permitting of ADUs, and the numbers really tell the story. Last year alone, 23,000 permits for ADUs issued here in California. That is a 60% jump year on year. Here in LA, the numbers were even more staggering. The number of ADU permits issued were 5 times that of single family homes. And the growth has become so big here. Even the co-founder of Airbnb, Joe Gebbia, has jumped in on this space. He launched a company called Samara last year. I spoke to him about the opportunity he sees in this space. Take a listen.
You could say that the idea of ADUs has become culturally popular, especially since the pandemic, because people's values towards their homes have shifted. They've changed. 58% of Americans still spend at least 2 or 3 days a week working from home. And currently 1 in every 5 households throughout the United States has 2 adult generations living together. So these are big shifts in the way that people think about home. And I think as we've seen these changes, we've also seen governments get behind this, because ADUs to governments are providing horizontal density throughout cities and neighborhoods. And so governments have changed laws to make it even easier for people to get ADUs. In fact, they're basically making it a right to have an ADU in your backyard. And as you mentioned, in California, they changed the laws in 2017, and since then have had a 17x increase in permit applications. That's phenomenal growth. And so I think it shows that there's a demand there, and that the easier that you make it for someone to have an ADU, there's clearly a market.
So talk to me about how Samara fits into this market, because you've got a template in place. How does it all work?
So the way it works is you go to samara.com and you configure your backyard unit. We have a studio, a 1-bed, and a new 2-bed unit. And so just like you would configure a Tesla online, you configure a Samara backyard unit. And when you hit order, we receive your order, and we go through a process where we handle everything for the customer. So that's both the construction of the unit in our factory, but it's also the hard stuff, the heavy lifting, the things that homeowners don't want to deal with. That includes permitting, soil samples, utility hookups, and a very long list that a lot of consumers, when they see that list, they say, you know what? They throw their hands in the air and they say, I'm not an expert in home construction. I don't want to deal with this. And so what we decided as part of the Samara brand is that we would take care of not only the structure, but also the service. Also everything that gets in the way of people saying, well, I'd like to have this extra space in my life. So we decided to do everything. And so after we get the order and we go through the whole process, we produce in our factory, we ship it on our truck, and we crane it in to the specified backyard.
I know it's been just over 6 months since official launch. What does that demand picture look like, and how concerned are you about that pulling back along with the demand in the housing market overall?
Well, you know, they're all commensurate. But I think what you'll find, what we've seen with people who want ADUs, is that it's actually a phenomenal income generator. And the majority of people get an ADU in their backyard to rent it out and to generate income. So it's a trend that I saw at Airbnb of hosts renting out backyard units. And it's a trend that we see more and more now that we're in the industry, because it's kind of a no-brainer. If you're a homeowner, you've already paid for the land. And now that we've created this simple offering where you can literally just order online, and we handle everything for the consumer and for the homeowner. It's a fairly clear proposition of a way to make some extra income.
You know, when you think about how the law shifted in California specifically, it was about addressing the housing crunch, the shortage there, and having more units. But I'm looking at a price point for Samara, and correct me if I'm wrong, it's roughly, what, $300,000 if we're looking at a 1-bedroom to 2-bedroom unit?
That's right.
I mean, that's a pretty high price point, even if we're looking at additional housing, trying to bring the cost down. I mean, how significant a dent, when you look at ADUs overall, do you think it can make in the larger issue of housing supply?
Yeah, look, I think it's going to take a lot of different ways to attack housing, not only in California, but across the country. I think this is one of many options that governments and developers have to make a dent in the problem. And the price, for California is fairly competitive when you take into consideration labor costs and the fact that we're doing everything for the customers, not just the construction of the home and the materials. It's actually the permitting costs and the water hookups and all of the nitty-gritty things that a customer has to pay for.
California's gotten a lot of attention around ADUs just because of the sheer number that you pointed to in terms of permits that have been given on ADUs. But we know a number of other cities, states have also been looking at this too. I mean, how much of a template do you think this can be for other states, whether it is on the West Coast or in places like Texas, to address the housing supply overall?
Well, in true fashion, California is ahead of the curve. They are leading the way on this, and other states are following. There's been at least 8 other states that have passed laws very similar to California's. I know Texas is evaluating some ADU laws at the moment, along with a number of other states across the U.S. Because, again, governments realize this is a fairly simple way to add more horizontal density. And the other point is that not only governments love it, but neighborhoods love it as well, because in California, cities have mandates to add more housing over the next couple of years. And neighborhoods love ADUs because rather than putting in, a multi-family mid-rise in the middle of the neighborhood, they can actually add the similar amount of density without adversely affecting the visual character of the neighborhood. So it's a win across the board.
What does that mean for Samara moving forward? I mean, I imagine that really opens up the market for you beyond California, where you got started.
That's right. I think we are well positioned to tap into this existing customer demand. And I think we'll actually expand the market by making it even easier for people to acquire a dwelling. And the other thing of why I think there's market growth here is that people are using this not only for income, but for a multitude of other reasons and use cases. And if you think about how life changes over time, what having extra space in your backyard could provide for you. Sure, it could be income on demand as you need it. There's also use cases of housing elderly parents close by, of housing college graduates when they come back post-graduation, of working from home, having a quiet, productive space, quiet, productive office right in your backyard. So I think the benefit of this form factor of housing is that it can be many things, and it can actually adapt with people over time, depending on the needs that they have in their life.
And as Joe mentioned there, for homeowners, ADUs are all about flexibility. He talked about the additional income generators through short-term rental, long-term rental. We've also heard from realtors that increasingly homeowners are looking at these spaces as an office space with so many more people working remotely. Now, we are outside the ADU now, and I want to walk this direction because that'll give you some perspective on where they are being built. That's where the ADU is. This is where the actual home is. In some cases, you've got homeowners who are actually living in the ADU so they can rent out the main home as well. Now, the housing affordability issue really has driven the growth that we've seen here in California. And it's worth noting that the average, or we should say the median rental here in California is 41% higher than the national average. But one of these units can go and rent for anywhere from $2,000 to $3,000 a month. So that's raised some criticism from those who say, look, this isn't exactly affordable housing. We should note it's not just California. Denver, over in Colorado, the most recent city to pass changes to their zoning laws to allow for more ADUs. We've also seen changes in states like Washington State. So this is something that is really taking shape across the country as we look at the housing crunch, supply crunch, as well as the affordability issue. By the way, the next step here in California where people are looking at is the potential for homeowners to be able to sell one of these ADUs. Right now, it's strictly limited to rentals. If they can actually build out the unit for roughly $300,000, potentially sell it, that'll really open up the real estate market here. Rochelle?
I mean, that's fascinating. You have to wonder what that'll do for like housing comps when you sort of factor that in with having the main house right there as well. Fantastic stuff. Our very own Akiko Fujita. Thanks so much. All right, before we go, let's give you a quick check of the market, see how they're faring at the moment. It's been really an oscillating picture this morning, really tracking in a narrow range at the moment. We're seeing the Dow there just up about 46 points, or about 0.15%. The S&P 500, they're also up about 0.25%, or about 10 points. And taking a look at the NASDAQ there as well, just up about 0.1%, or about 14 points on the day so far. All right, stay tuned on Yahoo Finance for market coverage this afternoon, as our team will be joined by Brendan Jones, Blink Charging CEO and President, to discuss the latest in the EV market. You won't want to miss that. That does it for us. We will see you next week. Until then, bye-bye.